Over the last year, the big six Canadian banks are up more than 54%, outperforming most financial sector comparables. And after the last set of earnings, my next guest is asking the question, are the banks really that cyclical? Here to break it all down for us is Mendonca. He's Managing Director at TD Cowen. Great to have you here.
Thank you.
Great report. We usually spend a lot of time talking about individual banks, but this is really a bigger question, I think, for all the banks. Maybe I'll just start with a big question saying, why are you asking this question?
Bank valuations are at very high levels. There are 3, 4, perhaps even more valuation metrics I use to gauge absolute and relative valuation. All of them are pointing to extremely high valuations. In fact, we're looking at things like 24-year highs in certain metrics, all-time highs in others. And when valuation becomes this stretched, we can only go one of two ways. You can either conclude that something's changed, something's different this time, or they're going to come tumbling down, that this is unrealistic. And I think a lot of the investors I speak to are grappling with that issue. So I spent time in this report trying to answer the question for myself and for investors.
So you actually, I'm going to bring your report right back to you,
Sure.
But you have basically, there's some basic reasons why we could see some of the outperformance. And then you talk about the philosophical reasons you're looking at. So the basic, number one is earnings. So tell me a bit about that.
So earnings momentum's been tremendous. In 2025, the 2026 estimates were up 8 to 10%. That's a lot for these mature banks. It was being driven by very strong margin performance. Capital markets were very strong, like my business. Operating leverage was very good, like over 3% plus for these banks. That's great operating leverage. That's revenue growth minus expense growth. Those positive earning revisions are very positive for bank stocks. So the fundamentals were just really, really strong. Now, the reason why that's not a terribly satisfying argument is you mentioned a moment ago that our Canadian banks have outperformed the U.S. in a meaningful way. Fundamentals have been strong for the U.S. banks as well. So there's something more than just strong earnings.
Okay, we'll get there. So the second of the basic reasons we could see the outperformance is you say capital is very strong.
Yeah, our banks are sitting on capital ratios. I think every bank is north of a 13% CET1 ratio. All banks are buying back stock all at once. In fact, so are the life insurance companies. So all the financial services companies simultaneously are buying back stock. And what's interesting is they're buying back stock and their capital ratios aren't going down because they're producing capital at a faster clip than they can buy back stock. That is a very attractive place to be. And importantly, they're buying back stock and they're not doing deals in the U.S., which matters.
That was the third one, yes. Yeah. We say you have here, there's no more dilutive U.S. deals.
So our banks, I think they've had a pattern over time. They generate 25% plus ROEs in the domestic business here in Canada. They accumulate a lot of excess capital, and in the past, they've used that capital to do deals in the U.S. Those deals have been dilutive. They're often not healthy for the stock. All the recent deals have been local. Think HSBC, CWB, Laurentian Bank. These are local deals. I think the market favors that.
Okay. Basic arguments as to why things are changing aside. Let's get more into the philosophical side. Basically, you have two. First one is that Canada's open for business.
Yeah, it feels like that. Like you watch the news every day, it sounds like our governor, Prime Minister Carney, wants Canada to be open for business after decades of, I don't want to pass a value judgment on the way our country was run, but perhaps we weren't open for business for a couple of decades, and it looks like the threat of trade breaking down with the U.S. has really lit a fire under Canada. And I get that echoed to me when I am visiting clients in New York, Chicago, Boston. I'm going to be in London in 2 weeks. I'm sure I'm going to hear it in London. That is a consistent theme.
The second one, and you actually say in your report, our favorite. This is about credit cycles, and things are fundamentally changing. So let's spend some time with that one.
Yeah, this is an important one. So there's really two parts of that one. One is that, maybe take a step back. Why have bank stocks traded at 10 to 12 times earnings, whereas consumer staples, discretionaries, industrials, some of them trade north of 20 times? Why are our banks why have they historically traded at these lower multiples? One or two great reasons. They're very leveraged. The asset to equity multiple prior to the global or around the global financial crisis was 25 times. Today it's around 19 times. So they're not nearly as leveraged as they used to be. But the other really interesting reason is banks do historically get themselves into trouble. Credit cycles can be very damaging to earnings and capital. Those are the two reasons why bank stocks, I think, have historically traded 10 to 12, and other sectors have traded at 20 times plus. What I'm arguing in this report is that credit cycles, the amplitude of credit cycles, are getting more and more modest. And I go through the report, I talk about the commercial real estate crisis of the mid-90s, and credit losses got to 140 basis points then. What was the next one? Tech Telecom, 2002. It was more like 110 to 120 basis points. Then we get to the global financial crisis, around 80 basis points. COVID.
So diminishing.
Constantly. And that's the point. Every credit cycle, and some folks don't even want to call them cycles because they don't feel like cycles, but let's call them every credit peak has been lower than the previous one. If that's true, if our banks truly are not going to blow up from a credit perspective and their capital is so robust, they could very well trade more like those very stable, non-cyclical names. Am I going to argue for 20 times? Absolutely not. But in the report, I argue that 13 to 15 might be the new 10 to 12.
Okay, let's dig into some of those
Sure.
not cycles or peaks or whatever you want to talk about, just in terms of what you're seeing. So you talked about PCLs declining over time. You talked about impaired PCLs dropping as well a bit.
Each cycle or
a
peak
little less.
lower than the previous. Yep.
Okay. I want to talk a bit about Canada's housing market and mortgages, because also I think you and I were talking earlier, there's unsecured and secured loans on the books. So tell us a little bit about that. Sure. And also Canada's how it's constructed in terms of what's on the books.
Okay, so why are credit losses lower? Well, 50% of the domestic balance sheet, 50% of our domestic loans are mortgages. Mortgages, by definition, are secured. They're secured by the value of the property. I don't believe mortgages will be the problem for our Canadian banks because they're secured, highly secured. Our banks are good lenders. They lend to the appropriate people. Now, I know you can see losses in mortgages. EQB currently is struggling with higher losses on their mortgages, different client base than our large Canadian banks. So loan to values remain very low. But there's another reason I don't believe our housing market is going to be a problem. It simply can't be. Housing stock accounts for about 25% of our national wealth.
Which is astounding.
Enormous number, 15% of GDP, over 1.2 million jobs in the country. We can't have a meltdown in the housing market. We can't afford it. So if this mortgage refinancing shock of 26 becomes a problem, we'll just drop rates aggressively to cope with it. And the shock in 2027 isn't even a shock. The increase, the delta between new mortgage rates and old mortgage rates isn't that great. So I don't believe mortgages are going to be the problem for our large Canadian banks. Now, there are unsecured loans, which we can spend a few minutes talking about. Like think credit cards, auto loans, unsecured lines. They're accounting for about 10% of the domestic balance sheet. That's simply not a large enough number, even if losses there increase materially. And I see that those losses are increasing. Credit card losses are climbing aggressively. Think BMO. Last quarter, BMO reported 663 basis points of credit losses on their card book. That's huge. But it's such a small book for BMO. It doesn't move the needle for them. And that's the broader point. Our banks are very profitable. Their pre-tax, pre-provision profit is sufficiently great to offset a material increase in unsecured loan losses. Now, could you get hurt on commercial? Sure. But that would happen if we have a problem with USMCA. We can talk about that later.
Well, let's talk. I guess I want to make sure we time. But I want to also just talk about, there seems to be more resilience in terms of, you talk about, and I'm not familiar, IFRS 9. So
IFRS 9.
Yeah, so
that's
building credit reserves.
That's a boring accounting one, but I can get into it if you want.
Yeah, we've got a minute for this one. So yeah, go ahead.
IFRS 9, we now, starting in Q1 2018, we started booking performing loan reserves. That's reserves on loans that haven't gone bad. That allows the banks to get ahead of a problem. When you see a problem, a deterioration in the economy, you book performing loan reserves. Our banks currently have total reserves, performing and impaireds, of 80 to 85 basis points. That's huge. Normal, like 3 or 4 years ago, that number was like 60 basis points. So we're holding an enormous amount of reserves. That is a huge cushion against a future blow to credit.
You also highlight, I'm going to condense a couple of these,
Sure.
but just that governments and central banks are acting more quickly and more aggressively, and also the banks have, and you alluded to this earlier too, I think, better detection at risk and understanding what's actually happening.
So on the bank or the government intervention side, I think 2008 was a near-death experience when Bear and Lehman and others failed. We learned then that gentle intervention is not the way. You go full board, you do everything you can to save the system.
You do it fast.
Do it fast, overdo it even, and deal with the consequences of inflation later, which is what we dealt with after COVID, and even to some extent even now. The consequences of getting it wrong are too great. So you throw everything at it and you deal with the inflation later, which was the lesson we learned from, more so from COVID than we learned from the global financial crisis.
So the culmination of all these reasons leads you to believe that, you know, banks are becoming less and less cyclical, which the re-rating on the PE and in terms of where it's going.
Yeah.
What can go wrong?
Oh, probably so a moment ago I talked about how mortgages are good, the 10% of unsecured lending is too small. Well, what's not too small is commercial lending. Commercial can still blow you up. There are sectors in commercial that can still be a problem. I think that if the three countries, Canada, US, and Mexico, can't come to terms with the USMCA later on this year and into next year, that could cause a blow up on the commercial side. What I conclude in the report, and I appreciate it's a very quick conclusion, I could just simply conclude that these countries know the state. They know what they have at stake here, and I'd like to believe we're going to find some resolution.
In terms of where it leaves us, you've got the three of the five that we can talk about. TD, of course, we don't talk about,
right.
But maybe just tell us who you like in what order.
Well, Royal or let's go in this order: BMO, Royal, and CIBC. The reason why CIBC has gone to third, it used to be first for a while, is the stock has just had tremendous performance. Yeah. It is the best performing over so many 3-5 years. Great performance. And until recently, it was bumping up against Royal Bank's valuation, which is, in my view, a little bit high on a relative basis. More importantly, CIBC has been a big beneficiary of the margin trade, the benefit to margins, and I think that's coming to an end later on this year. So the market's positioning themselves for a time when CIBC's margins aren't going to expand. Maybe a little bit on consumer credit as well. They're a big domestic bank with a big credit card book, and perhaps that's one of the reasons why investors are cautious. So I move CIBC to third. BMO I like. I think there's a real trade to be had there as BMO builds their ROE higher. Things like U.S. loan growth resurgent, margins improving, credit losses going down. So that's why BMO sort of sits in that sort of top spot. And Royal is second. That's really a valuation call. Royal is no longer a premium name in the sector. Royal historically traded 10-12% premium to the group. At the end of 2024, it was an 18% premium. Today, no premium really to speak of. I think eventually the market's going to pay for Royal again.
In terms of earnings profile, or just, I'll say earnings outlook for all the banks, it does sound from the report that, like, you know, we've had this tremendous growth, tremendous rise in valuation, but things are starting to slow down.
Yeah. We should prepare for more modest pre-tax, pre-provision profit growth. Normal for our banks is for pre-tax, pre-provision profit to grow about 7% a year. We've been humming at around 13, 14, 15 for a while. And it's because capital markets revenue has been so strong. My business, wealth management's been strong because markets are good. Operating leverage is good. Margins have expanded. It's just been tremendous growth. I think that's going to slow. I think capital markets will be more normal. I think margins have stopped expanding, although loan growth is improving. That's helpful. But look for pre-tax, pre-provision to go back to normal, 7%, or maybe even a period of below normal, maybe 5% for a period. We could benefit, though, from credit losses returning to a lower level, call it 37 basis points, but expect our earnings growth to be a little more pedestrian.